Welcome to the Keiser Report. I'm Max Keiser. Welcome to 2015. Stacy.
Max, I love 2015 so far. It's sunny.
Oh, it's fantastic to finally get, it could be a whole year trend, who knows? Now, for this episode, we're going to turn to some predictions we asked some of our guests to make this year. First up is Dominic Frisby, the resident gold bug at Money Week magazine. We started by asking Dominic whether or not 2015 is the year that central banks win, that they can now command markets as Neptune could command the seas.
Well, that's a very interesting question, and it's one that keeps me awake for many hours at night. And at the moment, they have won. You have to kind of be honest and go, they have won. But I think maybe in the latter half of the year, maybe their grip on the world will start to loosen and some freedom can creep in underneath their fingers. Japan, I think, could be the place that it all starts.
2015? Could that
maybe.
happen?
I mean, you know, at the beginning of the year, everyone always goes, it's Japan. It's all going to start in Japan. But I think maybe this year it will all start in Japan.
Well, I mean, it is the beginning of quantitative easing was in Japan.
Yeah.
And they are the most reckless of all the central banks. They're launching these multi-trillion-dollar programs, and they're buying stocks. They're buying.
Aren't they now buying more of their own debt than they're actually issuing?
Right,
so bizarre.
Yeah. Plus REITs, plus stocks. I mean, they're buying everything.
Of course, if you are right and that perhaps central banks are right, they can control and command markets, all those celebrating it then should be worried that basically they're proving everything wrong. Like they're proving that there are no free markets. Austrian economics is wrong. Keynesian, all economics is wrong. If there is just a command and control
central
communism.
Planning. If there's central planning, it seems to be the winner.
Yeah. Well, at the moment, it's working. I mean, it's awful when you think about it, because then you kind of think, well, what's the point of doing anything?
Well, it's working in the sense that the markets are trading higher, but you do have this enormous increase in both billionaires and poverty.
It's working for the 1%.
And the Soviet Union might have survived had they just instead focused on increasing house prices or something that the people could become more willing participants rather than having bread, like stand in line for a long time for bread. They like to stand in line. When they sell these new apartments, there's a huge line of people wanting to get in on the limited supply of these new apartments.
You're absolutely right. Do you know what really did for the Soviet Union? It was the collapse in commodities prices.
Exactly.
In the 1980s. And, you know, maybe the same thing for financial assets, and it'll do for the Soviet Union of America.
Well, you had a large dollar rally during that time, which led to the Plaza Accord and a reconfiguration of the global currency grid. So now that you've got some political conflicts again in the U.S., Russia, do you think that there's a concerted effort to try to take that battle into the commodity arena so that some of the price action in commodities that we're seeing is more of a political edge to it than the natural markets?
Well, maybe, but it sounds contradictory, because you'd think a low oil price will be good for the economy. It's certainly good for the real man because it brings down his living costs. But actually, the United States needs higher commodities costs because it needs the emerging markets to be making money if it's going to trade with them. And if the emerging markets are all going bankrupt, then the United States is kind of left on its own a little bit.
It also needs high oil prices, of course, for fracking.
Yes, that too.
Otherwise, it's no longer going. It's going to be the former Saudi Arabia of America.
Yeah, well, you make a very good point.
And so let's talk about gold. Finally, in the last few minutes here, what do you think about gold?
Well, how long is a bear market? I mean, I think this could be the longest bear market in history in terms of days counted. I need to check my figures on that. If you measure it from the very peak in early September, but in September 2011, in terms of magnitude of losses, what we have seen is typical of horrible gold bear markets, and it should be near an end around about now. The gold price won't stay low forever, but you know, the heady days of 2011, $1,900 gold, I think a lot has got to happen before people have short memories, but they still have memories, and a lot has got to happen before people dive into gold all out once again.
Well, I saw even the mining shares, Newmont was trading at the same price as 1999 and 2000, when gold, of course, was $250 an ounce.
I think it's probably even lower. at some stage in this year. It's been even lower than that. I mean, the mining shares, oh my goodness me, all the poor Canadians, they're all going, this is, you know, you've seen these veterans who've been in the game 50 years, they were there for the Briex scandal, they were there in the early 90s, and they're all just going, this is the worst I have ever seen.
Wow.
I can remember going to mining conferences in Canada in 2010, 2011, and the Canadian dollar was high and their stock was high, and they were all laughing at the huge amounts of American real estate they were buying just by selling a paltry amount of mining stock. Well, they're not buying it now.
Well, I guess we'd have to do our New Year's Eve end of our wrap-up interview dance. Yay!
Go gold! Go gold! Go gold! Thanks very much, Stacey. It's been a real pleasure being on your show.
What am I, chopped liver?
No, I said Max and Stacey.
Oh, sorry.
Did I not? I meant to
You said
very
Stacey,
much.
but I'm happy with that.
Well, in my head, I said, thank you very much, Max. Thank you very much, Stacey. You do a great job, and it's a great show that you have, and it's a pleasure to appear on it from every now and then.
Well, thanks, Dominic.
And let's go back to us in the future. Ooh. Hi, Stacey from the past. It is a great new year.
My mind is boggled. Hey, let's listen to what Steve Keen had to say. All right, Happy New Year, Steve.
Happy
Keen.
New Year to you, mate.
Fantastic.
It's goodbye to 2014. In comes another exciting year of the financial catastrophe.
Yeah, so, Stacey.
Well, I wish I had one of those woo, woo, and a little hat on and some confetti. But I know it's a fool's errand to have to guess and predict when the Minsky moment might arrive, but is 2015 the Minsky moment? Because surely stock markets, housing markets, everywhere you look are even higher, way higher than 2007 and 8. So is 2015 possibly a year that it could all blow up?
Well, it could, because this whole revival is starting from a level of private debt that we've never had before, except at the absolute peak of the Great Depression. And we're trying to build on a base where you've got lead weights attached to you at the same time. And it's only the Federal, the Reserve and the Bank of England, I've got more time for the Bank of England than the Federal Reserve, I might add. A lot of reasons for that. But they're all trying to pump up the asset market, and I believe pumping the asset market will drag up the real economy. And it's done it to some extent because it's dragged people back into debt again. But, you know, it's the old Led Zeppelin. It has to fall over one of these days.
The old Led Zeppelin?
Led Zeppelin, LED, you know.
This reference.
Okay, Zeppelins ultimately made of lead don't go particularly high. You can pump, you've got to use a lot of hydrogen to get them up to that height.
Oh, okay, I was thinking of the band.
Lead, that's where they came from, Led Zeppelin, you know. We should have them doing the music for tonight's party, but Led Zeppelin, the whole idea, you can't fly in a Led Zeppelin. A debt-based economy with the level of debt we've got now is the classic Led Zeppelin.
Since the financial crisis, incomes for the average wage earner are down 10% in real terms, and yet bubbles, the house prices are up, every single price of, you know, education, all those sort of costs are up. Is there a special, you know, number for the Minsky moment to happen, or can, if everybody agrees?
That's a good question. I think I had dinner a couple of months ago with the guy who's done the work on this, an American ex-banker called Richard Vague, who established two of America's major credit card companies. And I worked with Richard for a while, back in early 2013, I think it was. And he has done the empirical numbers like a good banker would do, of looking at global balance sheets and saying, when have crises occurred in the last 1.5 centuries? And his empirical answer was that every major financial crisis has had two conditions for it. First of all, private debt, and this is looking, not including financial sector debt, just households plus businesses, of more than 1.5 times GDP, and that ratio growing by 20% over a 5-year period, 20% or more. Every country on the planet pretty much qualifies as that right now. You know? And America is now growing from having dropped its debt by 20% from 1.8 to 1.6 times GDP. It's now back to about 1.65 and rising. It's only going to take a short while before it's back hitting the second of those two conditions. So every country on the planet's primed for a Minsky moment.
But should this Minsky moment happen like it did in 2008, and we saw the result of that? However, central banks had interest rates that they could cut. They had they had empty balance sheets or clear balance sheets. What are they going to do this next time? If 2015 hits, the Minsky moment hits, markets are tumbling 10% a day, what do? What happens?
They dive back in and try to reinflate asset markets. The whole mindset, and this is where I think particularly the Federal Reserve is the one responsible for this sort of thinking, believing that if you inflate the financial markets, you'll drag up the rest of the economy. And the reality we're knowing is you drag up the financial markets, but you push down the rest of the economy because most of us can't afford to live in the cities where the bubbles are really blowing, and the cost of living not falling for those people, and their wages are falling. So we're finding a real class divide being driven by this policy. It's supposed to be reinflating the economies.
Right. I mean, you do have that class divide that is growing.
Oh,
it is causing a lot more tension.
When Nick Hanau came up with that brilliant article, you would have seen it last year, when they were halfway through this year still, was the pitchforks are coming. Yes. And you can see this, you look, how long can the leaders of our societies continue pushing a policy which A, is not working as well as they said it would, though it certainly has caused a revival in America and England, pushing it without realising the social consequences. And that's what scares me. Finally,
I want to ask on this. We've often spoken to Jim Rickards, and one of the things that he suggested is part of the problem around the world of getting rid of this debt is it's always beggar thy neighbor. However, if central banks all agreed that they would buy gold at $25,000 an ounce, he reckons that 25,000 was the number he came up to dissolve all the debt. Is that something that could happen?
No. I'm sorry. It won't happen. No. Jim and I disagree on the inflation-deflation thing. As you know, I've always been saying deflation is what we're going to experience. And yeah, okay, if central banks would do that, okay, it would have a pretty dramatic effect. Do you think they're going to? No way.
Well, they did it. They've done it before.
25,000.
They've agreed. They've re-architected the global currency grid. During Bretton Woods Agreement, and then did the Plaza Accord. Yeah. So it was not inconceivable that they would come together again and re-architect the global currency grid.
Well, they should, because
and if they do, they'd probably have to bring gold into the equation.
Or they'd have to bring in what the Bancor, the old idea that Keynes had about a global currency which wasn't linked to any particular national economy. That would be far more sensible. America shot itself in the foot by not having the Bancor, and that's a huge part of where the chaos we've come from now, and with the power of the American financial system as well, but ultimately the weakness of the American economy.
All right, we're going to cut it off there. Steve Keen, Happy New Year. Thanks.
Thank you.
The Bancor, holy smokes, that'll be fantastic. Stay tuned for the second half. We talk Europe, Russia, and price-earnings ratios. You won't want to miss that exciting conversation on this first day of 2015. Welcome back to the Keiser Report New Year's Day special. Up next is Liam Halligan. We asked Liam Halligan about his outlook for 2015 regarding Europe and Russia. Bear in mind that this was a week or so before the ruble crisis, but he had some really interesting stuff to say about the price-earnings ratio versus the dividend yield in Russia. If it was historic before the crash, it's even bigger now. Take a look. Liam Halligan. Hey, New Year's week rolls on with Liam Halligan from The Telegraph and the new BNE, Business New Europe.
Business New Europe.
So what the frick is we could ask Liam?
Well, it's New Europe, Business New Europe. It's a new year. What's going on in Europe this year?
Well, in Europe, I think there'll clearly be Italy will carry on in recession. France may well hit recession. Germany may well hit recession. We'll no doubt get more billets doux from Mario Draghi.
Fancy words here on the Keiser Report.
Bidet doux? Is that you mistake the bidet for the toilet?
Doing everything. Billet doux, little presents, Max.
Billet doux. Presents.
Doing everything that it takes to save the euro. It's almost inevitable, I think, that at some stage this year there'll be another big eurozone lurch
I got a quick question.
in order, sort of preempting a big splodge of eurozone QE.
Okay, the euro crisis, we know, Greece blew up and Italy's in trouble, and there's also this idea that you had Fortress Europe, which was Germany and France. So my question is, the crisis in 2008, apparently it never went away, and in fact, is it going to roll into France, and can France now kind of experience the same kind of stress that some of these, what they used to call the peripheral countries, experience, and therefore would this crisis actually get into what they call the core of Europe?
Well, just at the back end of last year, Max, I wrote a series of 3 long features on France in the Telegraph and spent quite a bit of time in France talking to economists and visiting the banlieue, the very troubled regions outside some of the big cities, particularly Paris and Marseille. And it reminded me that obviously the first Euro crisis, summer of 2011, and then you had summer of 2012, of course. The first one, Italy got whacked, and a bit after Greece it got whacked. And France, the bond markets were just about to turn to France, having roughed up Italy a bit. And then Draghi came in with his speech, and then so France kind of escaped the Eurozone crisis. And for that reason, there was never the sort of political will to do proper budgetary consolidation in France, and that's why France is still 4
so
5%.
they deferred the day of reckoning.
Yeah, and so Germany and France have been at loggerheads towards the back in November and December last year and into this year, and it strikes me that spending is being squeezed in France, and you can see that, and it is 57% of the economy is state spending, and slower state spending is feeding into lower GDP growth.
We also saw the sanctions against Russia really starting to hit Europe, Germany in particular.
Yeah.
And now, however, I want to ask you...
As some of us predicted.
I wonder, yes, but you've also predicted long ago on the show, you said that Russia was a good place to invest in. And now Jim Rogers, a very famous investor, formed the Quantum Fund with George Soros many decades ago. Well, he's, for the first time in 46 years, he said he's gone there many times to Russia in 46 years, never bought the investment and wouldn't invest in Russia. But he said now, for the first time in 46 years, he's gone long Russia. He's partly because everybody hates Russia. He's a contrarian investor.
Of course.
Is he making a right call? What's going on? What do you expect for 2015 with these sanctions, Germany, Russia, blah, blah, blah?
Well, clearly, sanctions are hitting Germany. Merkel's come under tremendous pressure from her industrialists, not just the big Volkswagen, Siemens, Liebherr, but the Mittelstand companies too. There are 6,000 German companies working in Russia. German exports have fallen very heavily during 2014, partly because of sanctions on Russia. And, Germany could easily go into recession, and that's the beating economic heart of the Eurozone. In terms of the Russian equity market, it is, of course, much maligned, but the fact is now that even though you're going to have much slower growth in Russia, you might even have negative growth in Russia this year, even 2 successive quarters and a recession, given a sort of general slowdown and partly sanctions as well on the financial sector. But you've got a market now where the dividend yield is higher than the PE ratio. So the PE ratio is about 4.5, 5.
Yeah.
And
it's about 20 in the US, right?
Your viewers will know, if you have a P and an E, and the P goes down a lot, and then the E goes up, then the PE goes down even more. And we have a tremendous earnings story in Russia, I'm afraid, not least because we've had now for a couple of years a requirement that state-owned companies must dividend 25% of their net profit by law. And this is something that the Minfin has done to try and extract more money out of the likes of Gazprom, but also...
So the dividends are sustainable?
Well, certainly they're a lot more sustainable than the endless share buybacks we've seen here in the Western world that have been sustaining our overvalued Ps. I mean, look, the Dow's at an all-time high, the FTSE's flirting with all-time highs at a time when the Western world has yet to make a really sustained, convincing recovery.
To use the same PE versus dividends to give some context here. So the dividend yield in the US or the UK is probably on average less than 1.5%.
Yeah. And the PE is probably but 15 to 20 to 25. I mean, 25. the Schiller numbers on the Dow are 25.
Right. So to put it into context, you see the difference.
And you've got a PE in Russia of 5 and a dividend yield of about 5.5.
Right.
So largely because of, partly because of the law that it's mandatory for majority state-owned companies to dividend 25% of their net profit, but also because you've got a lot of private sector firms, post-Soviet firms that do have, I'm afraid, good corporate governance. A lot of the retailers and so on, and they're dividending like crazy.
And then finally, quick question here, because the sanctions have benefited China, whose Chinese companies are flying in there and doing the deals that the European and American companies have to close down. So where do you see this Russia-China relationship, especially in China? What's going on with China in 2015?
Well, as I wrote in the current edition of BNE, we had the APEC summit just towards the end of last year, and the same week we had the G20 summit, remember, in Brisbane. And so much more business was done at the APEC summit than the G20 summit. And a lot of the business that was done at the APEC summit, which is the Pacific Rim countries, China, Russia, and includes the US, was another big gas deal between China and Russia, and an acknowledgement that China and Russia will trade energy in yuan ruble cross, which has big geostrategic implications on reserve currency status, as I know you guys talk and think about a lot. But what you've had also is China doing these deals with Russia at a time when Russia is apparently isolated.
Yeah.
And China, this gas deal, these two gas deals have been 10 years in the making.
Yeah.
They could have announced it at any time, but they chose to announce it at the St. Petersburg summit in the middle of last year, and then just before Christmas, at the end of last year, precisely to say to the West, actually, we don't believe in a unipolar world. We believe in a multipolar world. And this is a very big synergy now. And then, of course, slightly less welcome, you've got China and Russia now talking about doing joint military exercises and all the rest of the saber-rattling that goes with growing commercial might. So this is the biggest economic synergy on the planet. China's massively growing population and insatiable energy demand. Russia's natural
resources. The biggest synergistic
Russia's natural resources
in the world, more than U.S., Europe.
Well, China and Russia have got a 3,000-mile land border, so there is that closeness, that proximity.
Well, there's a synergy because resource and no resource.
I talk about economic synergy, not cultural synergy.
No, but
the biggest cultural synergy on the planet, Max, is you and me, right?
Well,
because you're an American with a bit of Irish in you, and I'm a Brit with a lot of Irish. So, of course, nothing culturally can match the relationship between
the
Britain,
three of us here.
Well, you're sort of
this is
dodgy. She's Finnish or something.
The new troika.
Multipolar.
The ice queen.
We're multipolar.
We're
polar. Get it?
But in terms of commercial synergy, it works for both of them. And American and British commentators keep poo-pooing it, but this is going to go on.
I like that. It's a good way to end this episode, this part of the New Year's special on the poo-poo.
Excellent.
Let's make some of our own predictions for what 2015 will bring. With the bringing in of Cuba back into the world, I think we're going to see more multipolar world. And like at the top of the show, when Steve Keen mentioned the bank war, we could also see the dollar hegemony begin to fail.
Right. Well, I think in 2015 we're going to see something. I'm going to bring in a new concept that's never been talked about ever. This will be the first time anyone's heard this idea. Data pollution.
Data pollution. What's that, Max?
Well, data or big data was heralded as the new stuff of the new economy, just like oil was back 100 years ago. Eventually, oil turned into a massive ecological nightmare. There's no way to clean it up, and in the fracking industry, it proved to be a hoax. Data, big data, I think in 2015 we'll realize that also it's a bit of a pollution problem that comes with having everything run on data and big data. The Sony hack, I think, was a good example of this, where hackers can get into the data and they can create all kinds of mischief and mayhem based on pure data. And the NSA reveals, the CIA reveals, the Edward Snowden reveals, the Julian Assange, his participation in all this. It all revolves around data, transmission of data. And of course, cryptocurrencies are nothing more than data as currency, and this is going to be another big part of this data and data pollution as we make a transition into a different kind of world where the only way to fight the data pollution is to actually bring in a database currency like Bitcoin, like Starcoin, like Maxcoin, like other cryptocurrencies. So all in all, this trend toward big data will transmogrify a bit in 2015, and it'll take on all kinds of interesting dimensions. I also think that in the morass of big data, we'll see the first inklings of this idea that technology is evolving faster than humans and will eventually replace humans.
Yes, and actually I think also continuing on your theme is big derivatives. I think, at the end of the year, we saw Jamie Dimon lobby successfully Congress to remove that bit of the Frank Dodd Act, which separated derivatives onto their books, i.e. the taxpayer wasn't responsible for them. So I think he saw what perhaps the oil market and the junk bond high yield market regarding energy, I think that could be kaput. This could be a big story of 2015.
Well, derivatives are trading more and more on data aggregation. So as data pollution seeps into the system, the derivatives market will continue to have flash crashes, mini crashes, and huge melt-ups and melt-downs. It's all based on data. And for this reason, again, you'll see a move into gold. Russia's already been moving aggressively into gold, as has been China. So this is a way to combat data pollution and combat the apocalypse of data, which we'll see firmly in place in 2015.
So a multipolar world, big data, big derivatives, go boom, boom, kaput, kaboom.
Kaputski.
That's
As
it.
they say in Moscow, go completely Kaputski. Well, that's it for this first episode of 2015 with me, Max Keiser, and Stacey Herbert. I'd like to thank our guest, Dominic Frisby of Money Week, Professor Steve Keen, author of Debunking Economics, and Liam Halligan of BNE.eu. If you'd like to get in touch, tweet us, tweet, at Keiser Report. Until next time, have a great New Year's. Bye.